Hello Sector Watchers, welcome to the show. This is the 78th episode of Sector Spotlight on Tuesday the 4th of May. I'm recording it on Monday the 3rd of May. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands, as usual. If you have any questions, would like to share anything with me, comments on the show, whatever you feel like sharing, please use any of the handles on the screen and leave your comments and questions there. If you have any questions that are interesting enough, I might answer them in a mailbag segment in the show. Today is the first Tuesday of the month, and that means that we're going to look at monthly charts. That will take up a large part of the show, if not the better part of the show. And this Tuesday, the 4th of May, is actually the Remembrance Day in the Netherlands, probably like something like Memorial Day. It's a day where we remember all our victims of World War II and every armed conflict involving Dutch military after World War II. Exactly at 8 o'clock, the whole nation will be silent for 2 minutes with a big event and ceremony on Dam Square in the middle of Amsterdam. So this is your 30 seconds of cultural education of the Dutch. As usual, I start with a quick overview of what has happened in asset classes and sectors last week, and then we'll dive straight into the monthly charts for those asset classes and sectors. Starting with the asset classes on the RRG on the left of the screen, we can see that it was actually a quiet week, not a lot of movement, at least not in the classical stock and bond section. If we look at the table, then we see that both commodity ETFs, DJP and GSG, are topping the charts with 2.8 and 2.4% performance. But the benchmark, VBINX, is, minus 10 basis points, almost unchanged. And the same goes for stocks, which is like 0. So we need even more digits to see the change. And gold was down 20 basis points. So not a lot happened. And that reflects in very short tails for both ITOT and also for gold and the other fixed income ETFs here on the left, with gold in improving and LQD and HYG inside lagging but curling up a little bit. The biggest moves in real estate and both commodity ETFs. So the commodities, we've been speaking about that. We'll be looking at that later on the longer term charts. But the nicest and the best rotation at the moment is for real estate. We can see that the tail is moving further into the leading quadrant at a nice RRG heading. So right now that is together with commodities, probably the most interesting asset classes from a relative perspective. Stocks remain on the right hand side, bonds remain on the left hand side. If we quickly dive into a more detailed chart for the stock market, that is the daily chart of SPY here on the right, and then you can see that it continues to develop in a fashion that we've seen over the last almost 2 weeks already, where there is not a lot of momentum and it's pretty much moving sideways. We go a little bit higher, but the momentum is gone. The real power is gone, and I've had this trend line penciled in, that dotted line, and it's tested that again, and it's not being able to break higher. So we're moving sort of sideways here. And there is room for a corrective move without hurting the longer term uptrend. There's no doubt about that. That long term trend is still there. But I wouldn't be surprised if we can see some downside price action in the week to come or the weeks to come. What are we looking at? We're looking at this support level here. That's around 410, 411. But more likely is a test of that old resistance now, hopefully starting to act as support, which is just above 400. I've quickly penciled in a MACD just to show you. I really don't even, when you look at a chart like that, I really don't even have to draw in those charts to see that there is a rolling over or a divergence building up. But here is the MACD. You can see that it's rolling over, and more pronounced probably if we bring in the RSI. It's just the plain vanilla RSI as everybody uses it. I like to use it with 9 days and the look back period, and then you can see a nice negative divergence building up on the daily chart, which is sort of a warning signal that the upward power is on hold right now, as I said. So I'm looking for this market to move sideways or slightly lower in the weeks ahead. When we jump to the sectors, we see a different and a similar picture. We see that SPY was up 10 basis points, so that's almost unchanged. But if you look at what's happening under the hood, there is a big dispersion between the performance of the various sectors. And you can immediately see that with SPY way down the middle, and a sector like energy up 6%. This is already including today. So if I bring it to last Friday, which was April 3rd, it's up 3.9%. Financials 2.5%. Communication services up 2%. And you see SPY here then, by default, because this is a closed universe and this is all summing up to 0. It means that a couple of big sectors need to be below the S&P 500, and there you are. That's healthcare and technology with minus 2% roughly. And if we bring in today's trading on Monday the 3rd of May, then picture gets even more pronounced, with energy up 6%, financials 2.6% over the last 5 days, that is. So that's now Monday to Monday instead of Friday to Friday. But you can see that tech is now really underperforming the S&P 500. And I'm not sure if you remember, but I certainly do, that about a month ago, based on the seasonality patterns, I was writing articles, and I think I wrote an article in the Chart Watchers newsletter and in the RRG blog. And it was all around the theme that tech is a drag. And obviously, immediately after I wrote those articles, tech went up and it made new highs and it was strong, etc., etc. But I'm glad that I stuck to my guns and that I've learned from my mistakes in the past, where I was too fast adjusting my views based on short-term stuff and ignoring what I was seeing on the RRGs and just basically the whole picture. And you see here that despite the fact that tech went up and the tech had a few good weeks, it's still a drag. I mean, it's very clearly a drag. It's now 3% under the S&P 500 over the last 5 days, so it's now really coming down. And if you look at the RRGs on a weekly scale, you can see that tech is really pushing into that lagging quadrant. So that's paying off right now. And that is pretty much, if I have to summarize or to wrap my view of the market, is that I do think that the stock market is still in a healthy uptrend. But as I said in the asset class segment, and still based on that chart here on the right, there is trouble overhead. It's getting more difficult to rise, and there is quite some room for move on the downside, and there is some risk. And then if you look at what's happening here, and you see, the three biggest sectors, discretionary, healthcare, technology, all below the S&P 500. That is sort of dragging them. It's pulling the market down. And again, it's not. I don't see something like a crash, but like a healthy correction. And if those three markets, those three sectors are not outperforming, it'll be very difficult for the market to push really higher. So where are we seeing the performance right now? That's energy. It's in financials, which is a surprise, but I just wrote about financials, that it was expected to be an underperforming in the month of May. Well, May has just started, so we'll have to see. It's the last bit of April where financials were very good and they broke out to new highs. That's all good. And you see that the short-term tail is pushing into the leading quadrant, but May is still, like, we have about 21 trading days to go in the month of May. So I'm going to keep an eye on this one. It's the same. Technology started to perform very well. And here is where you are after a month. If we would make that a 5-week period, that's exactly the month of April. And put that here, then you see that tech is the second worst sector in the month of April, with only 2.8% gain against 4.4 for the S&P 500. So I'm not too worried yet about financials, but I'm going to keep an eye on it. Other sectors that are worth looking at. So here's energy pushing ahead in that improving quadrant. Still very low on the RS ratio scale, so cautious with that. It's looking good right now. I'm not sure how long it will continue to look good. Financials similar, short term good, but we'll have to see after this week. So next week we'll talk more about financials. Staples picking up inside lagging, up 2%, was a good week for them. Industrials, communication services, all at a nice RRG heading. You see materials inside leading, rolling over. These are all outperforming the S&P 500 last week. So utilities now pushing into the lagging quadrant. This is the short term. Longer term looks a little bit better. Real estate confirming its strength. Real estate is one of the sectors that is looking really, really good based on seasonality and has a strong rotation. So I'm remain pretty bullish on the real estate sector. And we also saw V&Q and the asset classes pushing to new highs. That's a good one. And then here we have discretionary, healthcare, and technology, all more or less at a negative heading. So that wraps up my view for the sectors and for the asset classes. And I think I made myself pretty clear what I think about the market going forward. We're going to look at monthly charts. And here we are with the monthly charts that have just completed for the month of April. Before we start, let me remind you of the fact that where most of the work that we do here in Sector Spotlight using RRGs is all based on relative strength. When we look at the monthly charts, we primarily look at the trends, at the price trends that we see on those long-term charts to give us a sense of what's happening price-wise on a longer horizon. If we start with the S&P 500, we can see that we had a pretty damn good month again for April with a new high and a new closing high and a very long bar which expresses quite some nice power upside for the S&P 500. So there's no doubt about it that this uptrend here is fully intact. And yeah, it's getting overstretched, and that's what I just said, tried to explain in the earlier segment. But there is plenty of room to the downside for this market to correct without harming that long-term uptrend. I think it's actually going to give us new buying opportunities. If we move to government bonds, then we see the weakness is still going on. We have this very clear double top that's being completed, and we're working our way lower. For the last, this is already May, so this is only today. So in April, we had an inside bar. We're sort of consolidating after quite a big drop in price for government bonds. Upside, quite limited. Downside, limited. So maybe for the next couple of weeks, price action between, what's that, 25.90, 26.60, 26.50. Something like that. So the big move has now played out. Market's now consolidating. Are we going to see a big rise and more down? Too early to tell for the time being. More sideways, but definitely not much higher. So yields remaining at the same level, maybe slightly higher. We move to the 10-year segment, so IEF, we see a similar picture, and that market is now resting at the support level offered by the previous highs that were set in 2016 and, and 2019 actually. So corporate bonds, that double top completed, it's very clear now, sideways for the month of April, but here also the upside pretty limited, and the downside all the way down to the former top of that range. So on the corporate bond side, there's also quite some downside risk there. And then the high yield part of the market, that's still in that wide trading range between roughly 80 and 89, just shy of 90, We're trading at the top end of that range. So if we're going to assume that this resistance is going to hold up, then here also the risk is clearly to the downside for high yield bonds. Now the more interesting stuff is in real estate. VNQ already mentioned that. A clear break higher with a very high closing high, highest level ever. And again, ignore this last bit, that's the month of May. This could be confusing, this little cluster here of bars, and if you want to get some more clarity, then I always use the trick of just going to a line chart, use a solid line, and then this breakout becomes crystal clear, breaking above the highs that were set in 2016 and then twice at the end of 2019, and we're now convincingly above that level. So the real estate asset class breaking out to new highs, making it one of the stronger ones. And then if we move to commodities, that is actually, we've been talking about it earlier here in the show, or well, I mean previous shows. This is a real long-term turnaround in the making, and in April we just closed above this resistance level, and we really have to zoom in to see that properly. And you can see here, and this line is quite arbitrarily, you could draw it even if you take the high of February, that was 25.10, and we're now, we closed here at 26.10. In any case, I think that this is now breaking out, and that's opening up the upside for DJP quite significantly, quite clearly. GSG is slightly different because it's not coming out of such a big base, but it's absolutely turning around. We see the trend line here that's now being taken out. So the whole commodity section, I think, is doing rather well, and we can expect more upside in the months to come for commodities. The stock-bond relationship remains pretty much in favor of stocks very clearly, but here also a lot of room to the downside for a correction without harming that uptrend. So the long-term preference remains for stocks over bonds. The steepening of the yield curve is completely intact. There's no change, a little hiccup here, but that trend is still going higher. And if we look at the dollar index, then that image is now back on track. We broke below that support. We had a pretty good month of March, and then April we came down again, so it seems to be resuming its downtrend in the dollar index, and that means higher prices for the euro versus the dollar. And now for sectors. Those of you who have seen Sector Spotlight, and especially Sector Spotlight on the first Tuesday of the month when I'm talking about monthly charts, know that I used to, past tense, used to use the regular sector ETFs, so XLK, XLP, XLC, etc. for my monthly charts. Those of you who have paid real close attention will also have noticed that for some of these sectors I used the unadjusted versions. So for something like utilities and financials, I did not use XLF or XLU, but underscore XLU and underscore XLF. The reason for that is that I feel that for these longer term trends, and especially when you want to mark support and resistance levels, the unadjusted pricing is the way to go, because the adjusted prices, they recalculate dividends and restate historical prices based on dividends. It does give you the proper perspective on what you would have earned if you would have held that security. But in terms of marking support and resistance, I think that the unadjusted versions are better, because those are the prices that are kept in people's minds, and they should be used for referencing old highs and lows. Now, instead of, because I was always struggling with these adjusted, unadjusted things, and all of a sudden this morning when I was preparing for the show, I thought, why am I not using the underlying indexes? We do have them on the database, and the ETFs, the sectors that we usually use, do nothing else than tracking those sector indexes. So from now onwards, I've actually taken a management decision to work with the underlying indexes instead of the derived ETFs, especially for the longer term charts. So if you are wondering why and you see different ticker symbols, that's it. So if we go over these the monthly charts here, then the first one is communication services, and obviously you see you can immediately see these resistance levels that are years and years apart, and they're very well respected. We broke higher, that uptrend is intact, but this market, this sector is not trading at an all-time high, and it's not closing at an all-time high. It's actually way below it. The high here is in 1999, so it takes a little while. And I made that mistake, I just discovered today. Nevertheless, that trend is still there, and it's very strong. If we move to the consumer discretionary, that is trading at a new high, and it's set a new closing high. So again, the last bit here, that's already today's price action. So the previous bar is what we're looking at, confirming its uptrend, moving higher, strong trend in consumer discretionary. If you look at staples, that is at a new all-time high and closed at a new high within the boundaries of the uptrend, but you can see if you compare it to these previous, to discretionary, for example, those were much more powerful, and this is a lot more shallow. Nevertheless, the uptrend is still very clearly visible. Energy is definitely not in an uptrend. Here we see a long-term downtrend. We do see that we tested support levels that go back 1999, 2002, 2003, and then were tested in 2020. Don't get me wrong, this is a doubling of price, so this is a serious range, but it's not in an uptrend. It did not close at new all-time highs. It did not make a new closing high, and actually upside is now very, very limited with a pretty heavy resistance level just above 400. So despite the fact that energy is rotating in that improving quadrant with a strong tail, we got to bear in mind that on the monthly chart, it's a really long term, there is quite some overhead resistance waiting for this sector. If we go to financials, then you can see, compare this chart with XLF. Just do it on your own system, run XLF and run this chart, and you will see the differences. And you will also see that these highs are very, very, very well respected. They go back to 2007. They were tested again in 2017, then again around the transition 2019, 2020, and now we break higher and we're pushing higher. So that is a very major breakout for the financial sector. Based on seasonality, I am expecting a little bit of a setback and some weakness, but there is no doubt that this longer term breakout is valid. And even if we see some seasonal weakness, that could probably give us some buying opportunities, probably towards the end of June, so in the next couple of weeks. If we go to healthcare, new high, new closing high, breaking out of that trend channel. Very strong sector, one of the strongest around. For the shorter term, we see some overstretched values and it could go down. But again, this sector has plenty of room to correct, and then this old resistance line is expected to come in as support in case of a decline. So long term, very strong. Short term, expect some weakness. Maybe a good moment to pick it up again. Industrials, one of the strongest sectors. Look at these monthly bars, very strong. March was really strong. April was pretty strong as well. New high close, uptrend very much intact. If you go to information technology, then as I said, we made a new high and we closed at an all-time high, but the close was not at the top of the range, and you see that especially the month of March. So the the 3-month momentum here in technology was already waning a little bit when you compare it to, for example, the discretionary sector and healthcare, who are pushing much higher month up month. And then technology did not do that, and we saw the weakness in the earlier segment, especially based on the relative. Materials, strong month, uptrend very much intact. This is one of the stronger sectors at the moment. Real estate, as I said, and I showed you V and Q, that's breaking higher. And here also, there's this outlier here, but the real resistance, I think, was somewhere around 249, 250. That breakout is very clearly visible. It's very clearly there. And real estate is now one of the strongest sectors, and it completely confirms the seasonal expectation as we laid it out in last week's episode of Sector Spotlight. And now we go to utilities. That's one of the 2 sectors that are actually not in an uptrend, together with energy. And you see that the last month, so the month of April, was the high 346, 345.90, and the previous high here in November was 344.80, 345. So we tested that resistance, and well, we're struggling with this over this. There's this high here, there's a high here, there's a high there, and we're struggling with that resistance line. So utilities is, well, this uptrend is very clearly there, you know, so just like staples, uptrend is very clearly visible. It's just not pushing to new highs just like the other sectors did, but this is one of the stable trends, you know, the defensive stuff. So we may see some interest coming into this sector, like staples and utilities and that kind of stuff, when we will actually see weakness from healthcare, discretionary, and technology, if the scenario as I have it in my head works out. So these were all the sectors, and I've actually I started creating a table for myself, and I want to use that to wrap up the show. What this table, I'm planning to actually update this every month going forward now. So this table marks whether we made a new all-time high, whether we made a new closing high, whether the sector is in an uptrend, and what the weight of the sector is. And as you can see, as we just walked through these charts, communication services is not at new all-time highs, energy is not, and utilities is not. Communication services is in an uptrend right now, that's very, very clear, and energy and utilities are not. So when we add those numbers up and sum that up, it means that 84% of the sectors made new highs and new closing highs. But 94% of the sectors is in a monthly uptrend. So let there be no mistake, the longer term trend for stocks is up. It's still going higher. Short term, near term, tactically, overstretched, etc. I foresee some weakness. I see some leadership from other sectors. So I do think that technology, discretionary, and healthcare are losing their leadership in the near term, and that will be taken over by some other sectors like real estate, like staples, like maybe utilities, etc. But the longer term trend, very, very clearly there. 94% of the market on the monthly charts in an uptrend. That wraps Sector Spotlight for this week. Don't forget, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern, and we have replays on the YouTube channel, and of course you can watch us on demand. If you have anything to say, anything to share, please use the handles on the screen below, on the screen right now. And don't forget to give us a like or any of the comments when you watch on YouTube. Please stay safe, and I hope to see you again next week with a new episode of Sector Spotlight.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.